Good afternoon and welcome to lecture 23 of risk analysis. In this particular class, we will be covering the balance portion of risk analysis. In the previous two lectures, if you remember, we had covered what is meant by risk, how do we measure risk, what is meant by expected value, what is variance, how do we measure variance, what is standard deviation, what is coefficient of variation. These things we discussed in previous classes, and then in addition to all these things, we also covered a certain graphical tools which are helping us in evaluating different alternatives. We discussed about investment risk profile towards the later part of the yesterday's lecture. In this particular class, we will start again with the different tools which are available to us in order to evaluate different alternatives. We will be covering acceptable investment diagram, which is also known as AID. Then we will see some other auxiliary criteria which are useful as far as evaluation of alternatives are concerned. So, we will straight away move to a small illustration, and with this with the help of this particular example, I will explain you how do we plot this acceptable investment diagram. If you look at this particular slide, it says that there is an investment of $1,000 for 1 year, and the possible after tax returns is given in the table. I will show you the table. So, investment amount is $1,000 and the return, which is after tax, post tax, is given in the table. The probability of each outcome is estimated and the rate of return is also given in the table. So, what we are given? We are given that investment amount is $1,000, and corresponding to this investment amount, we are given different values of return, expected returns, and the associated probability values. Now, if you go to the table in which returns are given, it is like this. The net return minus 900 has a probability of 0.05. Now, when you are talking of a return of minus 900, that means there is a negative return. That means there is a minus 10% rate of return on your $1,000 investment. Suppose $1,000 I invest and I am getting a return of 900 at the end of a particular year. It means I have made a loss and my rate of return is minus 10%. So, corresponding to this rate of return, my probability value is given to be 0.05. If you look at the third column in this particular table, it is giving you the probability values. Now, for the time being, forget about the last column. Just go to third row. The net return is given to be 1050. So, how much is the return in terms of percentage that we are making out of $1,000 investment? There is a return of 5%. Now, associated with this, the probability has been estimated to be 0.15. Then similarly, you can also earn $1,150. That means there is a return of 15%, and the probability of this happening is 0.40. Then you can also earn $1,300. There is a chance of 0.30. That means there is 30% chance that you can make 30% return. And finally, you can make $1,500 also post tax return on an investment of $1,000. That means there is chance of making 50% return, and the corresponding chance is 0.10. So these values are given to us. So what are the things that we have been given? $1,000 is the investment that I have to make, and then I can earn 900, 1050, 1150, 1300 or 1500. Associated probability values has been estimated, and it is given in the third column of this particular table. Now fourth column we have to calculate on our own. This is not part of the problem. This is part of the solution. So what we are interested in finding is what is the probability that the investment's rate of return will exceed the given rate of return. So if you see the second row, last column, a value of 0.95 is shown. That means there is a 0.95 probability that you will get a return of more than minus 10%. If you go to the next row, a value of 0.80 is shown. What does this mean? That there is a 0.80 probability that my rate of return is going to be more than 5%. Likewise, if you go to the next row, the probability that the investment's rate of return would be more than 15% is found to be 0.4. Likewise, I have calculated for other two rate of returns also. It is coming to be 0.10 and 0 respectively. Now this is part of the solution. I have tried to calculate that probability value which will have the probability to exceed the given rate of return. Now some more information is given as part of the problem, that also you can note it down. In this problem it is given that the investors, that means who is investing his money $1,000, they seek proposal that provide a probability of 0.95 that they will not lose more than 5%, and a 0.30 likelihood that their rates of return will be greater than 15%. So this is the aspiration of the investor. He wants some confidence that his return should be following these expectations. That means he should have a probability of 0.95 that he is not going to lose more than 5%. Besides this condition, he is also interested in ensuring that a chance of 0.3 that his rate of return will be greater than 15%. So there are two conditions: probability of 0.95 that he is not going to lose more than 5%, and second condition, he wants probability of 0.3 that his rate of return is greater than 15%. Now in this particular problem we are told to use an acceptable investment diagram AID to determine the acceptability of $1,000 investment proposal. I'll just like to quickly summarize the problem. There is an investor who has $1,000 to invest. He has calculated the different values of return and the corresponding probability values of their occurrences. Now, the investor is trying to achieve at least you have two conditions given, a probability of 0.95 that he is not going to lose more than 5% and a 0.30 likelihood that his rate of return will be greater than 15%. These two are his expectations, his aspirations. Now, in this particular case, we will use acceptable investment diagram to see whether this particular investment is acceptable or not. That means whether he should go for this particular investment or not. So, we will see how aid comes to our rescue in evaluating such kind of investment alternatives. So, what I do, I try to plot a graph between rate of return and the probability value. Now, what is that probability? Probability that the investment will exceed the given rate of return. So, on x axis I have got rate of return. It could be minus 10, it could be minus 5, 0, 5, plus 10, plus 15, plus 20, 30, 40, 50. So, these values are given on my x axis, rate of return. On y axis, I have got the probability that an investment will exceed the rate of return. For those of you who are not able to see the slide, I will try to do this on this piece of paper. So, on the x axis, I have plotted rate of return. On y axis, I am having probability value, probability that an investment will exceed given rate of return. So, this is what we have on y axis, probability that an investment will exceed given rate of return. These values already has been calculated and it was given in the last column of the previous table. If you remember, we had 0.95, 0.80, 0.40, 0.10 and 0. And the rate of return was given in the second column, minus 10%, 5%, 15%, 30% and 50%. So, if you just look at this particular slide, which gives you the rate of return values in column number 2 and the probability values that the investment's rate of return will exceed the given rate of return. So, what we are trying to do in step 1 is trying to plot these two column values. So, corresponding to minus 10% rate of return, you have a probability value of 0.95. So, this is nothing but one coordinate with you. Coordinate of this particular point is minus 10, 0.95. So, on x axis you locate the point minus 10 and y axis you locate the point 0.95. That way you will get 1 point. Likewise, for different values of rate of return and the probability values, you will get different points. In this case, in this particular problem, you will get 5 points. First point is minus 10, 0.95, second point is 5 comma 0.80, third point is 15 comma 0.40, fourth point is 30 comma 0.10, and fifth point is 50 comma 00. So now using these 5 points, you can draw a curve, or rather segment of lines, and that is how I have been able to plot this blue line. So blue line is nothing but the points coming from table previous table, column 2 and column 4. So will you be able to draw this blue line, which is also known as investment risk return potential? Yes, technology class, can you draw this curve? The curve is basically known as investment risk return potential. Now we will have to draw another few lines which will represent the aspiration level of the investor. You are clear how I have drawn the investment risk return potential? That I have done, suppose this is minus 10% rate of return, this is 0, this is 5, this is 10, 15, 30, like this. I am not drawing it on a scale, like this. And then here I have got probability of 1.0, 0.95, 0.80, 0.60, 0.40, 0.20, 0.1, like this. I have got probability values. Now I am finding this particular point minus 10 comma 0.95. So this is the point. This is the point. Second point is 5 comma 0.80. So this will be somewhere here. So I have to draw this like this. Then the third point is 15 comma 0.40. So this is this point. So I join it like this. Fourth one is 30 comma 0.10. So somewhere here. So I join it like this. And then finally I have got 50 comma 0. So this is this point itself. So I join it like this. So this is how you can draw, and this particular curve is known as investment risk return profile. Investment risk return potential. So one part of this diagram you have now able to you have been able to draw. Now on this particular diagram itself, I want to draw the aspiration level of the investor. For this I will use the two statements that is given. The first statement is that the investors seek a probability of 0.95 that they will not lose more than 5%. So what I have to do in this is, corresponding to this 5% return, and 0.95, I draw a line like this, which will be a horizontal line. And another statement says that he also wants a 0.30 likelihood that the rate of return will be greater than 15%. So I come to this 15% and 0.3 would be somewhere here. So I have a point like this. I join a line like this. So, I have one vertical line also here, and then these two I join it like this. The actual sketch you will get if you try to draw it on a scale would be something like this. The actual, this is not on the scale, but if you just want to see how on a scale the acceptable investment diagram looks like, it is shown on your slide. So, in this, blue lines represent investment risk return potential and the black line represents the aspiration level of the investor. So, the enclosure that the aspiration level makes represents the loss area. So, if you look at this particular black line, there are 3 black lines in this. Just under that, you have a loss potential, and then on top of it, you have all profit scenario. Now, you find that just at the top of the diagram, there is a slight portion in which the aspiration level of investor is not met. If there would not have been a common area in this, that means the investor is making profit as per his requirement. But just because you find that there is a small triangular portion at the top of the figure, it represents that the investor's aspiration level is not met to his fullest satisfaction. So, in such case, the investor will not like to go for such option. But there could be a different investor who is happy with this scenario. He may like to go for it. So, what you see? These diagrams are able to help you in taking your decision, but ultimate responsibility of the decision rests with the decision maker only. And under a given situation, the decision maker can come up with even different decisions. So, the first diagram which you saw, that was investment risk profile, and this one acceptable investment diagram, both are assisting the decision maker in arriving at his decisions in a more objective manner. So, basically these diagrams are graphic tools to aid the decision making process. Now, we will see some more criteria which helps us in arriving at a decision, especially when we are considering risk also as a part of it. Now, they are called auxiliary decision criteria. They are called auxiliary decision criteria. Now, in this, there are number of criteria. For example, there could be decision based on the expectation variance. There could be decision based on most probable future. There could be decision based on aspiration level. These criteria are coming to our rescue as far as arriving at a decision is concerned. Now, what we are going to do in this is, we will try to take up 2-3 alternatives and then try to see which alternative is the best one. You will find that under some tricky situations, these criteria would make your decision making quite simple. In the previous few lectures, as far as risk analysis is concerned, you might have noticed that we had gone in for that particular alternative which had maximum likelihood of getting the maximum expected return. That means, in other words, whichever criteria had the maximum expected return or whichever criteria had the least expected cost. These two criteria we had used. What were the criteria? Maximum expected return, maximum expected return, and second criteria, least expected cost. Suppose given two alternative, I find that the maximum expected return is corresponding to alternative 1. So, that means we would like to go for that particular alternative. Similarly, if we are dealing with the cost information alone, in that case we would go for that particular criteria which has got the least value of expected cost. Now, this is on the assumption that they have a almost equal variance. The problem becomes tricky when you find that the variances vary to a great extent. I will try to illustrate you through one example. So, even if you do not understand it right now, does not matter. I will show you with the help of a small example what I am trying to say. Just to introduce you to these auxiliary decision criteria, the expectation part we have already discussed. The second one is called most probable future. This is also one criteria to help you in arriving at an appropriate decision. In this, what we do is we find that investment which has the greatest return for the most probable future. This also we will try to see it through an example, and then finally we will see the aspiration level, which will depend on the aspiration level of the decision maker. One example of aspiration level we have seen just now in the previous problem. In that, investor had $1,000 to invest, and he had some aspirations, he had some expectations that okay, my returns should not be less than 5% in 0.05 cases, that means 5% cases. Similarly, his returns should be more than 15%. He wanted at least 30% surety, that means a probability value of 0.3. So, these were his aspiration levels. Now, these aspiration levels can vary. For you, there could be different aspiration. For me, there could be different aspiration level. This also we will try to see using some small example. It will be more clear at that point of time. Now, we will go to each one of these auxiliary criteria individually, and then with the help of an example we will be finding this. For example, the first one, expectation variance. in this, our objective is to minimize the variation. So, what we do in this is, suppose there are 2 or more alternatives that have the same expected cost or return, then in that case the one with the smallest variance of cost or return should be selected. This is the principle of this particular decision criteria. We are trying to minimize the variance. If you try to see this particular part with the help of a diagram, it will look something like this. Let's assume that we have got same expected value for 2 alternatives. Same expected value. Value could be cost or it could be return. Yes?
It has been interrupted for 5 or 10 minutes.
Okay, no problem, I will repeat it.
Okay.
So, what we are discussing here is the first auxiliary decision criteria. I told you in the beginning that there are number of auxiliary decision criterions. The first one is expectation variance. Now, what we do in this is, we try to go for that alternative among number of alternatives which has got the least variance. This under the condition that they have got same expected value. So, if you try to look at the diagram, it will be something like this. You must be familiar with the normal distribution. Now, just try to look at this particular diagram. These are different types of normal distribution. You can find the spread from the sigma value. So, the steeper the curve is, it has got the lowest value of standard deviation, whereas if you find that the spread is wide, you can understand that the variance is quite high. So, the blue one in this particular sketch, you find that its sigma is 0.1, whereas the middle one has got a sigma value, a standard deviation value of 0.2, and the lowest one has got a sigma value of 0.3. So, basically this variance is giving you the spread or the deviation or the dispersion. Now, one thing you must have noticed in this particular diagram is that the expected value or the mean value is same for all the 3 distributions. So, whenever you have got such kind of alternatives before you, in which the expected cost or the expected return, they are same and they vary in their sigma square or the variance. So, in that case, the expected variance criteria suggests that go for that alternative which has got the least variance. So, this is what we have discussed according to the first principle of this particular decision criteria. What it says, just to summarize you, if you have got 2 or more alternatives with the same expected value or with the same mean value and they vary in their sigma square values, then go for that particular alternative which has got the least variance associated with it. Now we will move to next principle of this particular decision criteria. So first part, if you look at this particular slide, it's clear. It says it is desirable to minimize variation, and it further says if two or more alternatives have the same expected cost or return, the one with the smallest variance of cost or return should be selected. And this is what I have been able to show you with the help of that diagram. Now we will go to next one. What happens if two or more alternatives have the same variance? In that case, the one with the smaller expected cost or larger return should be selected. Now we are talking of just the reverse situation. I have got the same variance, but the expected cost or the expected return of different alternatives, they vary. So this I can show you with the help of this particular diagram. You can just see this diagram. What you find here is that the standard deviation or the variance is same for all the three alternatives, but they vary in their expected values. The expected value, sometimes it is also referred to as mu or mean value. For the first one is 40, for the second one is 50, and for the third one it is 60. Now suppose that these three values refer to some cost, then we will go for that particular alternative which has got the least value of expected cost. Now if the problem is reversed and these mean values refer to returns or the money that you are getting, then we will go for that particular option which has got the maximum expected value of return. So this is what is meant when you say that if two or more alternatives have the same variance, the one with the smaller expected cost or larger return should be selected. So these two statements I hope is clear to you. Now we will go to the last one, which is slightly complicated. You will find that it says that if both the expected returns and variances are unequal for the alternatives, then the alternative with both the higher returns and lower variance is preferable. That means what we are interested in, higher value of return, higher expected value of return, and the least variance associated with it. We don't want a situation in which we have a low value of return and high value of variance. That situation we want to avoid. This will be more clear if we see one numerical example just after some time. So this is third statement. It says in case you find that there is a difference between expected return as well as the variance in two alternatives or more, you go for that alternative which has got the high value of expected return and low value of variance. This is what is meant by this particular statement. Now we move on to a small numerical problem in which it is given that there are three investment options, three alternatives A, B and C, and the probability of returns from these three alternatives, which happens to be of equal life. It is given in the table. So, what is given? You are given that there are 3 alternatives A, B and C, and you are also given what could be the possible return and what could be the associated probabilities. For example, you can read the first line of the table. It says possible net present worth of proposal. So, net present worth is already calculated and given in the table. There could be a net present worth situation of minus $1,000. There could be a net present worth situation of $0, $1,000, $2,000, $3,000 and $4,000. Now, corresponding to alternative A, probability for minus $1,000 is 0. Probability for $0 return or net present worth is 0.11. Probability of making a net present worth of 1,000, it is 0.26. Probability of making $2,000 net present worth is 0.22. Likewise, for $3,000 return or net present worth as well as for 4,000 net present worth, the associated probability values are 0.02 and 0.39. Likewise, I am given for alternative B as well as for alternative C. So, what is given in the problem? We are given that there are 3 alternatives A, B and C. What additional information? We are also told the different possible net present worth scenario and their associated probability values corresponding to the 3 alternatives A, B and C. The possible net present worth scenarios could be minus 1,000, 0, 1,000, 2,000, 3,000 or it could be 4,000. Now, we will try to calculate the expected value as well as the variances associated with each of these proposals. In first 2 lectures, we have discussed a number of problems in which we have been able to calculate the expected value as well as the variance. So, I hope you will be able to calculate the expected value as well as the variance corresponding to each of these 3 alternatives. Can you do it, technology class?
Yes.
Very good. What I have done, I have already calculated the expected return as well as the standard deviation for you for all the 3 alternatives. Now, you please cross check it, and if there is any error, please tell me. So, what you find that alternative A has an expected return of $2,320. Alternative B has a expected return of $1,620, and for alternative C you have an expected return of $1,550. The associated standard deviation values sigma is given to be 1476 for alternative A, 2257 for alternative B and 1359 for alternative C. Now, the important thing is which alternative to choose, and this we are trying to utilize the auxiliary decision criteria of minimizing the expectation variance. Now, if you look at these 3 criteria very closely, the maximum expected return is corresponding to alternative A and the lowest is for alternative C. So, what you can do here is that between A and B, choice is very simple. What you find, alternative A has higher expected return as well as low value of a standard deviation when compared to alternative B. So, if you try to recollect the last statement of the decision criteria which we discussed just now, what did it say? It said that in case the expected value and the variances are differing, in that case go for that alternative which has got the highest return as well as the lowest value of or lower value of variance. So, using that principle, choice between A and B is very simple. I will go for option A and I will discard option B. Now, you will find that I will be left out with two alternatives, alternative A and alternative C. For alternative A, my expected value is 2320 and my standard deviation is 1476, while for alternative C my expected value is 1550 and a standard deviation of 1359. Now, making a choice between A and C is difficult. Between A and B it was quite simple. We straight away used the third statement of the principle of this particular auxiliary decision criteria, and based on that we deleted B. But now what you find here between A and C is that expected value of A is more for A, but the standard deviation is also high, whereas for alternative C, although the expected value is less, the standard deviation is low. So, under such circumstances, you have to trade off between maximizing the return and minimizing the risk. If you remember, risk we are measuring with the help of sigma square or sigma. So, under this criteria, under this situation, you have to really trade off between maximizing the expected value and minimizing the risk. Now, some other criteria which we will study will help us in making us more clear of such type of situations. So, we will try to move to some other criteria, because we find that it is very difficult to resolve this situation using expectation variance criteria alone. So, we need to look to some other thing. Of course, one alternative here could be to trade off between maximizing the variance, maximizing the return and minimizing the variance. So, depending on your perspective of risk, depending on your requirement of return, you can choose the appropriate criteria. That is why I told you that you have to do a trade off analysis between maximization of return and minimization of risk. Now, we will try to go to some other criterions, auxiliary criterions, which further help us in arriving at a better decision. Now, we will go to another criteria which is known as most probable future criterion. It is referred to as most probable future criterion. Now, according to this criterion, the investment that has the greatest return for the most probable future is preferred. If you try to read this statement carefully, it says that look for that particular investment which has got the maximum return for the most probable future. Now, most probable future is assumed to be occurring because it has been associated with the maximum probability. So, we are calling that particular return as the most probable future which has got the maximum value of occurrence. So, if you go back to the problem in which different values of returns were given, net present worths were given and their corresponding probability values were given, you can calculate this. For example, if you try to look for alternative A, just try to look at alternative A, you will find that the maximum probability is associated with the net present worth of 4,000. It is associated with 4,000. For alternative B, if you see, the maximum probability is associated with a return of $4,000 again. And for alternative C, if you see, the maximum probability value is associated with the net present worth of $2,000. I will show you. Yes, just look at this particular slide. We are talking of most probable future. So, what you see in option A, alternative A, the maximum probability value is associated with $4,000. That means I am assuming that this is bound to be happening because it has got the maximum probability. So, I am quite sure that this is going to happen. Similarly, for B, if you see, the maximum probable value is for $4,000 and its probability is 0.46. Now, for C, if you look, you will find that the maximum probability is corresponding to a net present worth of 0.37. What is the underlying assumption here? That whichever option has got the maximum probability values associated with it is most likely to occur, and that is why we are calling it as the most probable future. Now, if you go back again to that particular slide, now I think it will be more clear. For alternative B, we have a probability of 0.46 that I am going to get a net present worth of $4,000. For alternative A, I think that I will be getting a return of $4,000, and for alternative C, I hope that I will be getting a net present worth of $2,000 because these values are associated with the maximum probability values. And I am assuming here that the future with the highest probability of occurrence is certain, is bound to happen. So, according to this particular criterion, which alternative will you choose? You will choose alternative B. Even though there is a tie between alternative A and B, in both the cases we are getting a return of $4,000, but we are more certain for alternative B because we have got 0.46 probability values as compared to the probability value of 0.39 associated with alternative A. So, according to this criterion, it is very easy to decide, and we find that alternative B would be most preferred option. Whereas, if you remember the first criterion, expectation variance, which we discussed just now, just a while ago, we had rejected alternative B straight away. So, what is happening? Different criterions are giving me different result, and sometimes it may so happen that even by using the same criterion, some people or maybe different people may arrive at a different decision. So, what we find here is that these are the tools which are helping us in understanding the problem, but ultimate responsibility lies with the decision maker. His situation, his upbringing, his risk taking capabilities, everything is coming into picture. Now, we will see some more criterion, and that is the criteria of aspiration level. This is the last among the auxiliary decision criterion that we are going to study. I have already explained you what is meant by aspiration level when we had discussed the problem under acceptable investment diagram. There the investor had two aspirations, a 0.95 probability that his return would be more than 5% and a 0.30 probability that his return would be more than 15%. These were two aspirations. Now, different decision makers may have different aspirations. Aspiration is nothing but your wish, what you want to achieve. That is what we are calling aspiration level. So, this principle is based on the minimum amount that will satisfy the decision maker. So, if you try to define aspiration level, you can take this as a simple definition. What is the minimum amount that will satisfy you as a decision maker? Now, under this particular decision criterion, we are going to take two situations. That means we will take two different aspiration levels, and we will see what are our decisions under these two aspiration levels. In first case, I am assuming my aspiration level is $2,000. That means I am looking for a return of $2,000 or more. So, can you find it out from the problem statement? What is the probability of return of $2,000 or more for different alternatives, namely alternative A, B and C? Now, let us go back to that previous slide. Yes, here it is. In case 1, I have taken my aspiration level to be $2,000. That means I am aiming for a minimum of $2,000. Now, if you look at alternative A, corresponding to $2,000, your probability value is 0.22. Corresponding to 3,000, it is 0.02, and corresponding to 4,000, it is 0.39. So, the probability that alternative A is going to give me $2,000 or more is the sum of 0.22 plus 0.02 plus 0.39. I will try to do it here. For alternative A, if you try to work out you will get a sum of 0.22 plus 0.02 plus 0.39. For alternative B, you will find it is 0 plus 0 plus 0.46. For alternative C, if you try to find it out, you will get a value of 0.37 plus 0.28. So, these are my probability values for different alternatives of having a net present worth of $2,000 or more. So, what I have done? I have not at all touched those values in which I am getting a return of less than $2,000. So, you will find a value of 0.63 here, a value of 0.46 here, and a value of 0.65 here. So, according to this particular criterion and an aspiration level of $2,000, what is going to be my decision? I will go for alternative C. I will go for alternative C because this has got the maximum probability values of giving me a return of $2,000 or more. So, choose alternative C. Choose alternative C. Now, what I do? I take different case. I try to reduce my aspiration level. I try to reduce my aspiration level. Now, let us say my aspiration level is to make some money. That means, I need not make, I should not make losses, I should make some money. So, if the aspiration is to make some money, aspiration is to make some money. So, what you will find? Corresponding to alternative A, you will get a value of 0.26 plus 0.22 plus 0.02 plus 0.39. Corresponding to alternative B, you will get a value of 0.07 plus 0 plus 0 plus 0.46, and corresponding to C, you will get a value of 0.11 plus 0.37 plus 0.28 plus 0. So, this is nothing but the probability value to make some money. Some money means you are not losing the money, that is first thing, and you are making some money more than 0. That is why you will find that I have left out the two values of net present worth, namely minus 1000 and 0. I have taken the probability values associated with $1,000, $2,000, $3,000 and $4,000. So, if you try to calculate this value, you will get a figure of 0.89 for this, a value of 0.53 for alternative B, and for alternative C it is 0.76. So, what do you find? For alternative A, you are having the maximum value. So, if you are going to use aspiration level criterion and you are aspiring to make at least some money, you will go for alternative A. Alternative A would be the most preferred one. So, what we find here is that different criterions can give you different results. Using some criterion such as, let us say, expectation variance criterion, we were able to eliminate alternative B. But the choice between A and C was difficult. When we tried to use most probable future, we were getting some other alternative as the most attractive. When we tried different aspiration levels, we were getting different decisions. So, the basic idea here is that we may get different decisions from different methods, and ultimately it is the decision maker who has to decide and take appropriate decision. These methods, whatever we have learnt, are helping us in solving the problem in a more objective manner. Using these methods, we are able to clearly understand the situation. We are not simply taking any decision, we are giving some reasoning behind arriving at a particular decision, and that is very, very important. Now, what I will do is, I will quickly go to one small topic which is called risk in aggregated cash flow. This will be the final thing in our risk analysis, and in fact, after completing this, we will be completing the portion on construction economics. From next class onwards, we will be discussing about construction accounting. So, as far as construction economics goes, this is the last topic that we will be discussing. So, what you find here is that suppose we are trying to identify the risk involved with a given cash flow. How to calculate that? That is what is meant by risks in aggregated cash flow. So, in this particular discussion, we are limiting ourselves to independent cash flow for a single investment. That means, we are assuming that the cash flows or the returns at different years are not at all related, they are all independent. That means, return of year 1 is not at all influenced, or it is not at all influencing return at year 2, which in turn is not at all influencing the return at end of year 3. So, if you look at this particular diagram, I am assuming that I am making an investment of x0 and I am getting a return of x1, x2, so on for, let us say, time period n. x0 is the investment, x1 to xn are the returns at different point of time starting from year 1 onwards. Now, I have listed out certain formulas to calculate present worth for such situations. Remember, our assumption here is that the two cash flows at different periods are not at all related. So, I have given you the formulas how to calculate the expected value of present worth under such situation. You can also notice that formulas for calculating the variance is also given. In fact, for variance you can use either the interest factor or you can simply use the formulas. So, these are some of the formulas which we try to use for evaluating the risk associated with the given cash flow. I will try to show you using one example in which I have assumed that at time t is equal to 0, I am investing rupees 2000. At the end of year 1, the expected value of return. Remember what is given is mu value. Mu is nothing but the expected value of return. My expected value of return at the end of year 1 is 1000. Similarly, at the end of year 2 it is also 1000, and at the end of year 3 is also 1000, and the corresponding standard deviation is 200. Now my question is to find the expected return and the associated risk, and I also need to find out the chance that above investment will run into losses. There are two questions. Now such type of cash flows can be given for different alternatives, and once you are able to apply these formulas, you will be able to know which alternative is risky, which is not, which is less risky. So what we are going to do is, we are going to calculate the present worth, expected value of present worth. So using the formula you can find that the expected value comes out to be 487 rupees. And if you try to calculate the variance, it is coming to be 82,958. Don't worry if you are not able to see the slide, I will be sending you today itself. So the sigma value is 288. Now just try to understand the difference between our initial classes and the class which we are going to have right now. Earlier we were not at all interested in calculating the variance associated with any of the cash flows. We were happy to get one single value of net present worth, and based on that itself we were arriving at a decision. We were thinking that whatever we have made the estimate is 100% correct. But in practice it doesn't work like that. As you can see in this particular cash flow, my expected value of net present worth is $487 or rupees, and the variance associated with is quite high. If you look at the standard deviation, it is 288. Now, so this is the risk involved in this, that my net present worth can have a deviation of this much, can have a variance of this much. So the next part of the question, if you see, it says what is the chance that this particular cash flow may run into losses. Because when you are telling 487, there could be some value, some time you may get a return of less than 0. That is what we are interested in. Less than 0 net present worth means we are running into losses. So using the concept of statistics and probability, you can try to calculate the probability of making losses. So what you do is you calculate the Z value. Z is given by x minus mean value divided by standard deviation. If you look at any statistics or probability textbook, you will get the formulas to calculate the Z value. And in those textbooks, you also get a normal distribution table. So using that table corresponding to the given value of Z, you can calculate what is the probability that you will make a money which is less than 0. That means you are running into losses. So I have found that there is a 4.6% probability that this particular cash flow may run into losses. So this is how you try to work out the risk associated with different cash flows. Remember, we have taken the simplest of the cases in which I have assumed that the return of year 1 is not at all related to return of year 2. That has made our calculations quite simple. If you try to analyze the situation in which the cash flows at different periods are correlated, then the calculations become too complex. You can try to refer to some good textbooks. You will try to get some information on those situations as well. But at this point of time, I would like to close this, and I would quickly summarize whatever we have discussed till now in all our 23 lectures. Because this particular lecture will complete our portion on construction economics. Next class onwards, we will be talking about construction accounting. So in this, whatever we have seen till now is, an engineer is supposed to make different ways to work out a particular situation, to solve a particular problem. Now, using the concept of time value of money, he tries to work out either the present cost, present worth, future cost, future worth, rate of return. So, using these criterions, you can try to select the alternatives. There your assumption is everything is constant, whatever you have assumed is bound to be happening. Then we moved on to cases in which we took depreciation and taxes into consideration, and then we saw what is the impact of depreciation and taxes on our decision. Then we moved on to sensitivity analysis. We varied one variable at a time, two variables at a time, more than two variables at a time, and tried to find out what is the impact on our previous decision. Has it changed or is it remaining same? Then we moved on to a special class of sensitivity analysis, and we refer to that as break-even analysis. Here we were more concerned about finding that particular point at which I am just able to recover my cost. So we did break-even analysis for single product company, for multiple product company. We discussed the phenomena of dumping. We also discussed about non-linear break-even analysis. We also discussed replacement analysis, because as an engineer we are also concerned with replacing an asset. If we find that the cost of keeping that particular asset is more, then we need to replace that. We discussed different principles of replacement analysis. We also discussed different ways of depreciation, and then we finally moved on to risk analysis, in which we were interested in finding the risk involved with a particular cash flow diagram, with a particular alternative. We discussed how to capture risk in the form of investment risk profile, in the form of alternative investment, acceptable investment diagrams. And finally, towards the later part of this lecture, we covered different auxiliary decision criterions. For example, we discussed expectation variance. We discussed most probable future. We discussed aspiration level. So with this, I conclude this particular lecture, and I would invite your doubt if you have got any. Thank you.
Hello, thank you.
Thank you.